Welcome everyone. Thank you for joining us for this update on minimum energy efficiency standards, particularly now that the government has confirmed some of the key parts of it in the Warm Homes Plan back in January. So I'm joined today by a great panel, Bobby and Matt. Say hello. And I'm Luke Loveridge. I'm a strategic advisor at Eco Approach. Very much working on the tech side of things and data. So today we'll be going through it's a brief session, just updating people on what's been confirmed, what's still to be confirmed, what are we waiting for, and then we're getting into like a discussion and a Q&A. It is only 30 minutes, so do pop in any questions that you've got in the chat, and we'll try and get to them and get through as many of those as possible. I would say as well that this session is being recorded, so if you do miss bits or need to drop out, you can get access to the discussion afterwards as well. Okay, so the agenda, I'm just going to give you a quick update, about 5 minutes, go through some slides of what we know at the moment, and I'll hand over to Matt and Bobby. So hopefully you can see my slide there. So what has been confirmed? So number one, we've now got a very firm date, so the 1st of October 2030 for all private rented properties, new and existing tenancies, to be compliant. Importantly, they have removed an interim date of 2028 for new tenancies, and now they've just shifted it to just one deadline. And they were also considering including short-term lets, so holiday lets, for example, temporary accommodation, but they're now not going to be including that. Now including a dual metric, so this is quite a significant change. So essentially, landlords will have to meet a fabric efficiency first, so loft insulation, cavity wall insulation, those sorts of things. And if there's any money left in the cap, they then go on to whether it's the heating system, so like upgrading the heating system, or something called smart readiness metric. So that could be solar PV, battery storage, for example. Importantly, there's now a grandfathering rule as well. So if a property can secure a band C under the current system before the 1st of October 2029, that will be deemed compliant for the full 10-year life of that certificate. So that's quite an important piece there, which we can discuss later. They have confirmed that the maximum spend cap will be £10,000 per property. So that's up from £3,500 under old regulations, but it's lower than what they were proposing initially, around £15,000. And again, a really important point here is that they've confirmed spend will count from the 1st of October 2025 last year and onwards. So that removes a massive barrier for landlords that might have been holding back spending on their properties. And there's a couple of exemptions that they're going to include as well, in addition to the sort of current proposed ones. So there will be a cap on the maximum spend cap of 10% of the value of the property. So if the property is worth 90 grand, then the cap will be £9,000, not £10,000. And there will be some optionality around, for example, solid wall insulation. So things which might be quite disruptive to the tenants or might be not necessarily be feasible for certain properties. So what are we still waiting for? So number one is, and this is a big one, we're waiting for an update to the current EPC methodology. So it will be transitioning over to the home energy model, and that is looked to be introduced by October 2026. And this is where there will be a number of metrics, but what we don't quite are clear about at the moment is how hard it will be to actually pass certain bands. Will a band C now, for example, might be a band D under this new metric system, for example. And they are actually consulting on EPC bandings for this home energy model currently. So that's quite a big one, and I would encourage you to sort of feed into that as well. And really just to, even though we've got a lot of like clear steer and confirmation to sort of start laying plans and actioning things, it's not law yet, so it is expected to be laid to Parliament in Parliament this year, and then coming into force into 2027. And in terms, they have set aside about £2 billion for zero and low interest loans. But the eligibility in terms for landlords needs clarification. So how I read the plan, it felt like landlords weren't actually included in those low and interest-free loan support. So there will be, some clarification needed on that. It felt like it was more towards homeowners. Not to say that lenders won't necessarily offer those anyway, but in terms of government-supported loans, that's still ambiguous whether that includes landlords or not. And then just to touch upon enforcement mechanics, so there are potentially up to £30,000 worth of fines per property, so that is quite significant. But how local authorities will be funded to actually enforce that isn't clear at the moment. So there's still a few bits unknown, a few bits of uncertainty, but a lot of solid progress in terms of giving landlords and lenders and agents more sort of detail and confirmation and direction of travel for sure. So I've just done just before we go into sort of the Q&A, I just wanted to go through, the reasons why landlords would act now versus waiting. So in terms of acting now, we've got a number of considerations here. So one is actually reaching compliance. So if they act now, they could probably reach a C under the existing rules. And because we don't know how the banding will work with the home energy model, it might mean they need to actually do more work. So there could be a lower certainty of actually getting compliant under those, under the new rules, under the new dual metric standards. There's also sort of a financial element to this as well. So currently VAT on many improvements are 0%. That is due to expire in March 2027. So unless the government extends that, and they might do, just the total cost on some of these will automatically go up by 5% anyway. I think a big one is around the supply chain. So I get the feeling a number of landlords might wait until closer to the deadline to actually carry out some of these upgrades. But we've learned from previous experience, it's going to be hard to find tradespeople to actually do the work. So I think there's a big emphasis and to raise awareness amongst landlords now to ensure that they can actually secure the supply chain to do the works in the first place. On financing, as I mentioned, it is still uncertain whether landlords will get any sort of support in terms of low interest loans or from the government or back from the government. And there are actually a number of sort of additional borrowing and lending products out there at the moment. And I suspect in 2026 there will be other lenders, starting to launch competitive products there as well. So, but another big one is penalty. So up to £30,000 per property, as I said. For acting now, you can lock that in for 10 years, 10 years compliant. Whereas wait until closer to the deadline. If you can't secure financing or the supply chain, you might risk going past that 1st of October deadline and incurring penalties. So I think there's definitely a case for acting now, but obviously some people might want to wait closer to the deadline, and particularly for laws to actually be laid in Parliament as well. And then just very briefly, how will it impact lenders, brokers and estate agents? I've just sort of highlighted a couple of opportunities and risks for each of these. So for lenders, there's definitely a security risk for their back book. Can properties be lended out? Will landlords be facing fines? That sort of thing. But there's also an opportunity around retention strategy, I think, and also how you can get more new customers as well by having certain criteria or different lending products to help them in this. There's also for agents, I think we've discussed this in previous webinars as well, inventory shrinkage. So will landlords sell off properties? So you might be seeing a smaller market. But I do think there is, significant opportunity around a new revenue stream for letting agents as well, helping their landlords to get compliant. And lastly, for brokers, I do think there's a risk around deals potentially becoming more complex. Will lenders restrict criteria? Will not reaching compliance be an issue to actually complete on mortgages and remortgages? But I do also think there's an opportunity, not just around new revenue streams, but also to differentiate yourselves in terms of renovation finance, green finance, essentially, and offering your landlords sort of more routes to release equity, that sort of thing. So that's it from me. I do now just want to hand over to Bobby and Matt for to introduce themselves and have their initial reactions. So Matt, if I can hand over to you first, please.
Yeah, of course. Thanks for that. Thanks for the detail. Really helpful. So I'm Matt McCullough. I'm head of sales at Aldermore. So my involvement today is really I'm not a complete MEES specialist, but what I am, I think I am. I'm educated well enough around the landlord market, tenant market, and the buy-to-let arena. And going through some of these changes here, I'm hoping to answer some questions around the significant change that faces the landlordscape and lenderscape in the future.
Brilliant. And yeah, so what's your sort of initial reaction to the Warms Home Plan and how it affects lenders and Aldermore, what you're thinking internally?
So the first part of it is that the Warms Home Plan's given us a bit more clarity, a bit more certainty. You made a point before around the report doesn't specifically say are any of the interest-free funding available for landlords. I think the way to look at it doesn't specifically say anything's ring-fenced for anybody. So I think there's an element of there that will start to strip out, or at least it will create some innovation for lenders to provide a potential solution for landlords in that space to develop. I tell you, the key thing for me, right, is that what this is going to do, right, is clearly drive us very quick towards regulatory compliance, right? It's a very short time frame. I saw an excellent article this morning, actually, from Louisa at Paragon that stated that very clear, there's like 2.5 million properties privately rented now currently fall below the minimum EPC C required. Now, to get them to the standard, that means that it's going to be approximately 1,400-ish rental properties per day have to be upgraded to meet that EPC requirement. That's a lot, right? Now, if you think about the time frame it takes to get there, you're talking 1,700-ish days. There's not a lot of room for failure. The key thing is, though, right, that these improvements being done to get to the EPC C, let's say £5,500 worth of average costs, it's potentially costing each property to upgrade. That's £13.5 billion going back into the economy that wasn't there before, right? Now, that's without a potential increase in March of 5% VAT. So there's a lot of uncertainty, a lot of pain for landlords as well, because, the cash has to be found from somewhere. I understand that. But on the positive side, there's a lot of economical growth going into that from there. And also, let's think of our self-employed entrepreneurs that are in this space now actively fitting on properties. And these businesses, there's an element for them to grow over the next few years as well.
Excellent, thanks, Matt. And Bobby, if you can just introduce yourself and then sort of give an initial reaction in terms of an installer perspective.
Sure, thanks, Luke. So I'm Robert Butter-Ellis, Renewable Sales Manager here at Eco Approach. We've actually been developing an end-to-end, fully in-house MEES compliance process in advance of all of this. So that includes assessment through to retrofit, due to the post-assessment as well. So we're a little bit of a step ahead. These clarifications are really, really welcome. They remove a lot of uncertainty for us and a lot of the barriers that were there before. I think the headline here really is simple. October 1st, 2030 is the finish line, and it's not the starting line. I know, Luke, both you and I, we've seen some communication that it's from this date, so that's really important to clarify. We did have interim 2028 targets. They're now gone. So we've got a clear 4-year runway for this. And the way that we get there is no longer about a single score. It's about metrics. So we've moved to this dual metric standard. It's a fabric first approach. Essentially, we have to fix windows, lofts, walls, and there's no more putting heat pumps in tents, which don't really help anyone. And it's not what we want. There is a bit of a win for landlord choice here. Once we've got that fabric sorted, they can then choose their path. So they can either upgrade the heating system or they can opt for smart readiness. So essentially, if a landlord has a perfectly good gas boiler, they don't have to rip it out. You can use solar panels, batteries, smart thermostats, those sort of measures to hit that secondary metric instead. We've got a clear £15 billion government commitment, and we've got a flexible path to compliance. I mean, all we really need now is to deliver homes that are warmer, healthier, and more affordable, which is exactly our aim here.
Brilliant, thanks, Bobby. So I'll get on to the Q&A. We've got a couple of questions in the Q&A, but first, I thought, Matt, I could come to you. You know, obviously, specialist lenders are going to have a specific role in this. So instead of just sort of the zero low interest borrowing, what else do you think, how do you think you could be supporting your landlords as that specialist lender, knowing that you're not going to be necessarily competing on those zero interest loans anyway, that might come through from some of the larger lenders?
I think there's two areas to look at, really. I mean, the obvious one that everyone's already on the front foot with, and they have been for a while, is just proactively pricing landlords in the better quality stock space more proactively. So, you know, you get the EPC A, B, some C products where you've got a slight interest rate reduction on the front end. You know, some people have called it greenwashing and all that great stuff. For me, I think the innovation starts with actually how you start to give more funding to people that have got better quality properties. Now, for example, right, so the interest cover ratio that every lender will adhere to when it comes to actually providing a loan to a landlord based on the rent is made up of all sorts of different variables, right? Now, to get that percentage, one of the variables in there is EPC rate and quality. So rather than just lower the rate and make it a fair market, I think there's some innovation there around stretching the borrowing for people that have got better properties, that are wanting to grow, that can either take money out of them properties, increase with an increased value, if that's materialized, to fund more improvements and or fund more purchases. So I think that should be something where we go. I don't like the remit of better product for better property. I like fairer product for everybody, but I like better processes for better property. And I think if that enables people to borrow more and more often because of an ICR flex in better quality stock, I think that's where we go. The second part to that, though, is one that isn't talked about enough at the moment. It's probably in the retention customer space and the product switch space, because everyone's thinking about new to market. You know, we see stats around 50%-ish mortgages that are being placed, are EPC C or above, depending on where that data is sourced. I'm not quite accurate and reliable on that. But what I would say is that no one's talking about the retention of these customers. What happened on the back book? That's where it matters, right? Because lenders clearly, you know, if they wish to securitize stock in future, get a better securitization process for better quality stock. So there's going to be a drive to retain better quality stock, or at least signpost how to improve current stock to better. I think there's more needed, but there's a lot needed there, definitely. You know, I don't think people are talking about that enough. But again, you might know more than me on that respect.
Interesting. And I suppose just to sort of follow up on that as well, sort of stretching the amount of borrowing available. You know, with a portfolio landlord, you know, let's say they've got 5 properties that need upgrading, that's potentially 50 grand they need. You know, is there going to be sort of stretch and like more flex in terms of, like, maybe they're highly leveraged at the moment, like how, you know, how are you going to consider that?
But in theory, it happens today, but it's done on price, right? So if you take someone who, and I'll make this scenario up hypothetically, right? But if today's EPC B product was 4.8%, you know, interest rate over the 5-year period, and an EPC C plus is 4.9, right? That 10 basis points makes a difference if the rent just meets the ICR coverage. So that 10 basis points will always give someone extra borrowing if it's 10 basis points less. So that happens today. But like, why should somebody who's got a B-rated property have essentially a cheaper mortgage rate? It should be that the rate is the same. They've just got a greater capacity to borrow based on the quality of stock, right? Now, clearly by 2030, all stock's got to be C anyway. So what do we do then? You know, you can't just go, right, well, I'm just going to make everyone's that price, because there might be implication of finance, swaps. We're not going to go into that piece, but you can see the volatile. But what I will say is that I think we need to move away from just the price gaming. It needs to be process led. We need to start baking that in now and create, well, a new habit, basically.
Brilliant. Thanks for that. So, Bobby, I'll come on to you. I think a big worry for me is that now that we've got a single date, 2030, rather than like that interim 2028, I think landlords might wait until the last moment. What's your sort of thoughts on that? And what's the experience that we've had previously when there's been these hard deadlines on like prices and like ability to make compliance?
Yeah, I mean, probably everyone in this call will be some sort of veteran and will have experienced this in the past. But essentially, we see as we approach compliance deadlines, things get more expensive, and the supply chain can't cope. The retrofit supply chain in particular has been hit hard with the Eco4 drop-off. At the Eco Approach, we've been lucky as we've diversified our retrofit division, but a lot of others haven't had that opportunity. And as with any industry, when you see demand outpace supply, you'll see price increases. You'll see, I mean, landlords and letting agents here might remember the introduction of the ICRs 5 years ago and how difficult that was to introduce. And this is far more complex. There are a lot of moving parts in this. But I think probably the key thing to note here is earlier is better. There are incentives to do things immediately, and there will be grandfathering as well. So that is a clear signal from the government that they want people to start now. So if a property achieves a C rating under the current RD SAP system, and that's before October 2029, that will be considered compliant until that certificate expires, and they've already confirmed that the 10 years will be staying. So my message really would be to get started now or as soon as you possibly can to reduce risk. But we will see struggles in the supply chain, and the longer you wait, the bigger the risk it's going to be.
And actually, one question from the audience says, if there's a C rated property now that becomes a D in say 2032, what would the procedure be? I would say before the methodology changes, I would maybe just get another EPC, which then lasts 10 years. So it'd be like 2036, 2037 that they then need to think about it. But yeah, again, Bobby, you can sort of chip in on this, but if it does expire in 2032 and it is a D, then yeah, they would have to go through the MEES process and become compliant, basically.
Yeah, absolutely. I think it'll be local authorities policing this. I don't think we are aware yet of what the central register would look like, but considering we have that for EPCs already, that will exist. And I think there are some things which will lock some landlords out. I think just owing to the changes to the EPC format themselves, especially the energy cost metric, that's going to be quite a big win for tenants. So they will be able to see estimates of actual running costs. So you might be at a disadvantage if you can't show that to potential tenants. So there is a push to move to this new metric. And sooner really the better. That's essentially what I'm saying.
And obviously it depends when the EPC is done, but if it's relatively recent and it's a C, or even just a high D, then you might just need to do something like you might have done all the insulation works, for example, or it might just be a loft insulation, and then you might just need a smart thermostat, for example, or something like that. So the works hopefully shouldn't be too much there. Right, just in terms of some other questions, actually that sort of leads into this. So what types of properties landlords actually will be likely or incentivized to retrofit now, or will benefit from retrofitting now? Bobby, what's your sort of take on that?
Yeah, so I mean, as I said, the energy costs of a property, they're about to become much more visible. The EPC at the moment is quite opaque. The rating doesn't really mean much to the general consumer, and that will change with the introduction of the new energy cost metric. So I see tenant value is going to shift purely from looking at rental costs to a total cost of occupancy, which will include that. So properties with a lower total cost of occupancy are going to be more attractive to tenants. If you're sitting there or renting a property at 2,000 a month and your energy costs are 200 a month, and someone next door is 2,000, but their energy costs are 100, that puts you in a disadvantaged position. So I think most landlords will benefit from that. Well, the landlords that are making changes to properties will benefit from that, and they'll benefit from it now.
And I do think, just because of the grandfathering rule, if they are a high D, and maybe they just need a thermostat or some loft insulation, something like that. Personally, so I used to have a high D, I would just get on and do those works. It might be like £500, £1,000, something like that. Don't even need to wait for the financing, really. If it's some more, if you can't reach a C within 10 grand, then I would probably wait and just to see if there are any sort of other exemptions available, or I would probably wait. But if you can reach a C within 10,000, particularly if it's like a lower cost as well, sort of minor works, £500, £1,000. Personally, I would probably just crack on and start doing it to get that under the current methodology rather than under the new methodology, which might be more granular, might result in some bands going down. We don't know yet. Maybe even some going up, but because it's more granular, I suspect it'd be more strict.
I don't think we've actually seen a change to the SAP system or the calculation system, which hasn't brought things down. They've weighted things differently. I think we're essentially on cost at the moment, but there hasn't really been a time where that's given properties a boost. So my expectation would be they would be worse. How much worse, I don't know. But the general consensus is that they will go down on future updates to the calculations.
Cool. We've got a few minutes left. Matt, I thought I'd come back to you actually. More around risk. So how are lenders assessing the risk now around these regulations, and particularly back book, but also new customers? Because I know, some major lenders, when the previous MEES came in, they wouldn't lend on properties below an E, for example. So how in Aldermore, or maybe your general market view, how are lenders sort of approaching this from a risk perspective?
To be fair, we've been on the front foot for a while, because the EPC legislation, as you know more than most, is changed historically quite a lot in a short space of time. So everyone's already been in a space to try and get their house in order, so to speak. So in the current world today, every lender now, if not, I'm sure they will, but us after now, we are basically keeping a careful eye on our portfolio EPC distribution, right? That's not just on the front book, that's on the back book. What's changing? So for example, we have a really good in-life team that look after our landlord, after our highly leveraged landlord in the background. And these partners, they meet with their landlords every year to annual reviews, and as part of that process, they will undertake certain credit stewardship processes, such as what EPC ratings are certain properties, what state of repair are they, any valuation challenges we need to be aware of, not just for us but for the wider portfolio that clearly our property is leveraged against if we've done a portfolio stress. So we're already on that front foot to see what are we exposed to today should regulatory change, as it is, come our way. And then we do a lot of work around what properties do we have now are currently classed as valid accepted, i.e. the exceptions process for the valid exemptions prior that we'd noted. Given the volume of consultation we've gone through and the changes, it's very hard to nail down a specific process for it. What I will say is, with this new approach moving forward, I feel that there'll be an aggressive stride forward to find more about retrofitting. I think that'll start to become very, very common, very proactive in the near future. And there's a reason for that as well, right? I want to go back to the prior point you discussed, is around the timings, around for the change, the small cost change, what type of cost it'll be to change certain properties to meet the requirements. And the one thing that we've just got to be mindful of, right, is that this is now also overlapping the Renters' Rights Act, right? Clearly, the one thing to be mindful of is that any business owner, landlord, or if you owned 12 franchise shops across various towns, if you are incorporating a new cost, that does start within the business, and that will start with potentially your product line, right? So for example, in mortgages, if swaps go up, guess what? Products tend to go up. The same might happen here, right? Cost of enhancing properties goes up, rent could go up. And I say could because in some areas it probably will, but how it does is very different today, because with the Renters' Rights Act coming into play, that will now be a more elongated process and a more controlled process, which means that landlords do have to think more carefully and strategically about these changes, not just about the EPC regulation reform, but also rental reform as well. So I think that's something to be really alive to, both from a credit risk point of view, to make sure we're meeting the requirements, but from a strategical landlord point of view, to make sure it all aligns in line with both sets of regulations.
That's a really good point, actually. And we've done a previous webinar on the overlaps of all of this regulation as well. So, but that is a great point. This isn't sort of in isolation. And there's also like AWAB's law, right, as well. So damp and mold and like the health and well-being of the property. That concludes. We're actually a bit over time. So I just want to say thank you, Matt and Bobby, for joining us to discuss. And again, just to remind everyone, there will be a recording afterwards, which will be sent out to everyone who's registered. So thanks again. We'll schedule some more of these as we know, as things progress through Parliament, and maybe drill down onto specific topics. I know, Matt, you mentioned before about tax and whether people can landlords can get rebates, etc. So maybe we can sort of go into that a little bit more. So thanks again and take care. Have a great day. Bye, everyone.
Cheers, Luke. Thank you, everyone.